Okay, let's get into the nuts and bolts of the investment banking business model. First, let's take a closer look at securities underwriting. We will focus on equity, bond, and syndicated loan underwriting. This activity provides the bulk of investment banking fees. Let's say a company wants to raise $500 million by selling financial instruments. This could be equity, it could be debt. An investment bank will intermediate this process. In fact, usually several investment banks will compete to win the mandate to lead that underwriting process. The lead underwriter will be responsible for setting the terms of the deal and managing the sale of the newly issued financial instruments. Let's consider the case of an equity sale. If a firm is selling equity for the first time, this is called an initial public offering, or IPO. A listed firm can sell more equity in a follow-on deal. This is also called a seasoned offering. The investment bank will meet with the business and the potential investors to negotiate a price and interest in purchasing shares. This process is called book building. The investment bank may be responsible for buying the entire issue at a guaranteed price and selling it at another to outside investors. Hopefully this price will be higher. The spread between the price they buy and the price that they sell determines their profits. So, assuming the investment bank buys 100 million shares at a negotiated price of $5 per share and sells those shares at a price of $5.25 each, then a spread of 25 cents will yield a nice profit of $25 million. These profits are not guaranteed. Morgan Stanley famously mispriced Facebook's IPO, and its share price lost nearly 50% in the subsequent weeks. It took a full 16 months to return back to the initial valuation of $38 per share. The underwriter would like to set an offering price that clears its inventory at a profit. However, that price should reflect a fair valuation of the business. Otherwise, the bank may risk damaging its reputation and future business prospects. Bond underwriting follows a similar process. Let's instead consider a syndicated loan. That's a more interesting case. Usually a commercial bank will grant a business loan. However, when these loans are very big, this might be too risky. So for these large loans, a group of banks and other lenders may come together and collectively fund the deal to our borrower. This allows them to spread the risk among themselves. Here, the underwriting bank will negotiate terms of the loan on behalf of the lending syndicate. They will be responsible for both the origination step and the servicing step in the lending process. Leading the syndicate will generate a lot of fees for the underwriting bank. The other syndicate members will act more like silent partners that provide funding for the loan. These other lenders will earn the usual interest income from investing in a loan until it matures. Suppose firm X would like to buy target firm Y or a segment of target firm Y, but does not know the correct price. Suppose firm Z wants to divest a division and needs help finding potential buyers. Investment banks are frequently involved in negotiating and executing deals of this kind. They conduct research on potential acquisition targets, or they assist sellers to find buyers. They are experts in estimating the value of public and private companies using financial modeling techniques. And then, in terms of financing, the M&A advising bank can also assist with underwriting new securities to finance the deal. Any of the underwriting options, equity, debt, syndicated loans, they're all on the table. Finalizing the details of M&A transactions can be complicated both from a financial and legal standpoint. Investment banks are well compensated for the advice and services that they provide. Okay, here are the various investment banking products. We have fees from underwriting equity, bonds, syndicated loans. Here we can see a breakdown by initial public offering and follow-on offerings. For debt, we see a breakdown by investment grade. These are companies with good credit ratings, and then below investment grade firms. In 2020, total fee revenues from equity underwriting, from bond underwriting and M&A related activities were about the same order of magnitude. Fees from syndicated lending were about half as much. Securities trading is the other key activity of investment banks. This consists of market making and proprietary trading. Market making occurs when an investment bank creates a market where investors can come together and trade securities. There are many other securities firms that do this, but investment banks play a central role. Brokers execute trades on behalf of their customers, earning a fee or commission along the way. Let's say our investment bank buys a Facebook stock at an ask price of $20 and sells it to a customer at the bid price of $21. Then it will earn a $1 profit. This profit is called the bid-ask spread. The dealer arm of an investment bank may carry some stock in its inventory. In this case, you might find yourself buying the Facebook stock from the bank itself rather than the bank trading in markets on your behalf. Combining securities dealing and underwriting has clear synergies. If I am an investment bank that underwrites a new stock issue, then it is easy for me to carry some leftover stock in my inventory. Prop trading is when a bank takes an active position in a financial instrument to make a profit. They are not assisting customers. They are trying to make a profit for themselves. A position trade involves taking a long or short position in a security for several weeks or several months in anticipation of a favorable price movement. Arbitrage trading usually involves exploiting small, temporary mispricings in financial markets. This mispricing should not exist, at least not in theory, and so this presents an opportunity to make a profit. It can also make markets more liquid and prices more efficient. Here is one final chart. It shows total investment banking and trading revenues for the 12 largest US and European institutions. Total revenues in 2020 were just shy of $200 billion. About $150 billion of that came from fixed income and equity trading, so that's around 75%. The remaining 25% came from investment banking fees. Okay, in this session, we have covered the main activities of investment banks. Securities underwriting. Investment banks help firms issue new securities and place them with investors. Trading. Investment banks assist in the trading of securities that are already out there. And then there's corporate strategy. All three avenues are important sources of fee-based income for investment banks. Finally, this is an industry that has gone through some dramatic changes. Standalone investment banks are few and far between. The largest investment banks now sit within bank holding company structures.